computer wasn't working for the last class, so we didn't record anything. So let's do it with you guys. Record it, put it out there. Anyway, we want to do consolidations today, right? But before we do consolidations, why don't we quickly go through, sort of quickly anyway. Let me give you a problem, and you guys work, okay? And what I want you to do is I want you to do all the accounting for investments in other companies, right? Okay. What's the first thing that we worry about? What do you worry about? The first thing you do, you see, when I say they made an investment in other companies, stocks, bonds, common stock, preferred stock, bonds, made an investment in other companies. What's the first decision you want to make? First thing you want to find out about? What is it? Otherwise, you can't do the entries. You don't have to. You don't work the problem. How much control you have. How do you determine how much control you have? Yeah, percentage you have in the company. If it's bonds, you don't have any vote anyway, so no control. So any amount of bonds is either what? Held to maturity or it's marketable security. Okay? Right? No control. Right? Everybody got that? If it's preferred stock, same thing. Right? You don't have any vote typically. So then we're talking about common stock. We can split these up a little. Okay? So what are the three categories for control? How much control might you have? How about no control? You guys agree with that? Come on, you guys. Wake up. Leave me alone. No control is one, right? Okay. What's another one? Significant influence. Good. What's another one? Control. We got it. Those are the three categories. Okay. We decide first which one of those we're in. Okay. So what's no control? What percent might you own? Yeah, one share, and the rule of thumb is up to 20%. Everybody agree with that? That's no control. So the first thing I'd look for is, hey, how much do I own, huh? What would be significant influence? What's that range? I guess 20%, over 20%, up to 50. Less than 50, huh? Okay, I'd have significant influence. I'm not taking what the market gives me. If I own less than 20%, I think I'm taking what the market gives me. I don't have any control, right? If I own 20 to 50, I now have significant influence. I'm helping run the company, right? I'm on the board of directors, certainly, right? Okay, control, what would that be? Obviously, over 50%, right? So 50 to 100%, over 50 up to 100%. Everybody agree? I've got control. That's the first thing that you want to know. So once you've got that, you kind of got it made, right? Okay. These are all called marketable securities. Everybody agree with that? Okay, so types of marketable securities. Okay? There are three types, huh? What are the three types? And what's it dependent on? So this was how much control you have, right? How much you own. What's the other one? How long? Okay, and so what are the three time frames? Days, a few weeks. What would we call it, that investment? Investment in trading securities. And I told the other class, don't use TS as an abbreviation on the exam. Why? I can't tell treasury stock from trading securities, so give me a little bit more. Make sense? Okay, don't use the same abbreviation for two different things. Don't use INV, they're probably why. Could be inventory or investment. So, think about it when you're writing down your answers. Okay, so investment in trading securities is what it's going to be, right? When we buy something, we'll have an investment in trading securities, won't we? What do we credit? Cash. Yeah, so we're going to do that, okay? All right. If I have significant influence, wait a minute, whoa. That's days to a few weeks. What's the next category? Okay, up to 1 year. So more than a trading security, but up to 1 year. What do we call that thing? Investment in what? Available for sale securities. Short term. Everybody agree with that? That's a T, honest. Okay, short term? Everybody agree with that? All right. How about over 1 year? 1 year to forever, I guess, huh? Investment in available for sale, long term. What are all the credits going to be for these, of course? Credit cash. Of course, right, guys? There's nothing to this. All right, what if you have significant influence? Debit what? Investment in affiliate. It's an affiliated company, right? Okay. Credit what? Cash. Got it. Okay. So it gets to be common sense once you get your head around this stuff, doesn't it? Okay. What if I have control? Debit what? Investment in a subsidiary. Absolutely. And credit what? Cash. Okay. So let's say the company that we're making an investment in has 600,000 shares outstanding. Okay, what does that mean? They're the ones that are being traded out there, right? Issued less treasury stock, basically, huh? Okay, there's no treasury stock is issued and outstanding. Okay, 600,000 shares. And let's say the market value is $8 per share is the market value. Now that's the market value on the date of purchase, okay? All right? Then let's say that at the year-end market value is $9 per share. And let's say the net income for the year really good year, $1 million. I had a company worth $4.8 million and they made $1 million in a year. I'd be really happy, really happy. So then let's say we pay a dividend of $400,000. Okay, company reinvest the other 60. Okay, and then because the market's really happy with us, the value went up by $1. Everybody see that? So even though we paid that dividend, the value still went up by $1. Okay, so everybody's happy. All right. Then let's say that the number of shares I have, let's say that I bought 6,000 shares. Okay? This is 6,000 shares. Here, let's say I own 35% of the company. I own 35% of the stock. By the way, if I own 6,000 shares, what percent of the stock do I have? There's 600,000 shares. What percent do I have? This is 1%. Everybody agree with that? How many shares do I have if I have 35%? 35% of what? 600,000, don't you suppose? Right? There's 600,000 outstanding. What's 35% of 600?
210,000.
So this is 210,000 shares. You guys agree with that? It's easy, isn't it? Okay, and then over here with control, let's say I own 75% of the company. Okay? I buy 75% of the stock. How many shares is that? 450,000, 600,000 there, right? So 75% share. If I own more than 50, right? Okay? So it's going to be, what do you say, 450,000 shares. Okay. So no matter how I give you the information, okay, guys, what I'd like you to do is record the original purchase, and I already told you what the deficit credit for. Record the original investment, and then, so that's the original purchase, and then record what you need to for the change in market value, what you need to for net income, and what you need to for dividends, and all those are here. Assume these are all here, okay? Oh, assume 3 different scenarios. One, I'm going to hold it just for a few weeks. One, I'm going to hold it for, say, 6 months. And one, I'm going to hold it for, say, 5 years. Okay? So do all 3, in other words. Okay? So, do them all. Remember, you don't make an entry. Right? Under no control and under significant influence for one of those. It's 2 different ones. Okay? Remember that? Take a look at that. what, you have 3 journal entries and 1 you don't do an entry for. I guess the code would only be 2 entries, really. Not too good. Oh, no, that's just a market right here. We're not selling. No. If you did, you'd have a realized gain or loss, right? You'd be an unrealized gain. When you're doing the entries, how much control do you have? Right? In the first column there, you're just taking what the market gives you, right? You're not making it happen. You're taking what the market gives you. Disappears. Middle one, significant influence, you're making it happen, right? Top right for that, top right for that, you know? These are all the same. Anthony's here. Is Walter here? Right? Madison? Bella Howard? Teresa Stevens? Emily Wolf? Cole Wilson here? You guys getting there? Ready to go? Ready to do it? So how many shares do we get? 6,000 in the first column there? Okay? And we're going to call it either investment in trading securities, investment available for sale short term, or investment available for sale long term, right? Depending on how long we're going to hold it. It was $8 a share, right, when we bought it? So how many is that? How many dollars? 48,000? So wouldn't it just be debit 48,000 here, credit 48,000 cash? It would, right? So you're going to get these, aren't you? What do you have to know in order to get these? How long are you holding it? What percent do you have first, right? And then how long are you holding it? Okay? It all would be the same. Okay, how many shares is it over on the investment in the affiliate one? 210 at $8, how much was that?
1,680,000.
1,680,000. Everybody do that? That's what your paper looks like? Okay, what would you do if it's an investment in a subsidiary? Well, now it's 450,000 shares, isn't it? Right? At $8, how much is that? 3,600,000. Okay, everybody good? So you got those, don't you? Okay. All right. So then let's try. That's buying it. What about the year-end market value? If I'm using one of these marketable security methods over here, market value methods, right? That's market value I'm going to use. Market method. To adjust to market. What do I call the middle one here, the significant influence? Equity method. What am I going to do? What's the method I'm going to use if I have control and I have investment in subsidiary? What are we going to do? Eliminate it and consolidate, right? Consolidation. I'll show you elimination in just a minute. Consolidate. That's the type of accounting we're going to do. So consolidation, equity method, market method. Okay, I'm taking what the market's given me. The market gave me an increase in value of $1 a share, huh? How many shares do I have? 6,000. How much did I gain? 6,000. So the stock's not worth 48,000 anymore. What's it worth now? 6,000 shares at 9 is 54,000, right? You're going to add 8 to it. So all you're going to do is you're going to debit investment in trading securities, right? For how much? Your gain, which is $1 a share on 6,000, right? Just the gain. 48 plus 6 is the 54 in there, right? And I call this a what? Unrealized gain on what? Trading securities. Now, the key thing for this is, what kind of an account is that unrealized gain? What statement does it go on? Income statement. This thing goes to the income statement and the income, right? Revenue expense accounts, gains and losses. This is a gain in this case. Get close to what, guys? Be close all your revenue expense accounts too. Gains and losses. Retained earnings, right? It's going to go to retained earnings. So it gets in equity, right, through the income statement. Everybody got it? Okay. So that's it for that one. How about if it's more than a year? Or up to a year, I'm sorry. What do? I still want to increase the investment, right? This time it's available for sale, short term. How much do I want to increase it by, of course? To 6,000, because that's what it went up by. And this is still going to be called an unrealized gain, isn't it? This time it's going to be on available for sale short term. It's still going to be for 6, isn't it? All right? But what kind of an account is that? Does not go in the income statement. It goes directly to what? Equity statement. So this account is on the equity statement, and it is a what kind of an account? Other comprehensive income. Right, guys? It does not run through the income statement. Okay? Goes straight to equity. So if you want to know about this stuff, which could be huge on companies, right? If they got a lot of investments, where do you look? In their equity statement. That's where it is. Okay? It's a really important thing to know. A company could have more losses on their stock portfolio, their stock holdings, than they have retained earnings. You know, as in they're bankrupt. Okay? But it looks like they still have positive retained earnings. They're not bankrupt if the market recovers, but if it doesn't recover, right? They're in big trouble, right? The stock's there invested. Okay, what would it be if it's over 1 year? Exactly the same except what? Yeah, call it available for sale. Long term in both cases, right? That's it. Okay, big deal. Okay, everybody remember these? Got them? All right. What would we do with that change in market value if we're helping run the company? No entry, right? We don't care what the market value is. We care how much the company's earning, right? So the change in market value, what would you say here? No entry. How about the change in market value over here? I'm going to eliminate it anyway. No entry. Got it? Okay. Now let's do the net income. What would we do with the net income? In each of these, in all of them, when they report a net income or a net loss, what will we say? No entry. I'm taking what the market gives me, which is a change in market value. Why did the market value go up? Because they had a positive net income. You don't want to record it twice. Once for the net income and once for the change in market value. So no entry on all three of those. Is that what you have on your paper, I hope? Or you will when we do a quiz. How about, though, if I'm helping run the company? I made the net income happen, didn't I? So what happens is I think I increase my investment in the affiliate by my share of the income. What portion of the company do I own? 35%. What was the income? 1 million. How much did I earn? 350,000. That's how much I increased my investment by, I think. And the reason I increased it is because I earned. And I call it income from what? Affiliate. If it was a loss, it'd be the reverse, right? I debit a loss and I credit the investment. Okay? That's it. This is too easy. What would I do if it's consolidation? You don't have to do anything. No entry. Why? Because they're going to eliminate it anyway. You can record it if you want, and then eliminate it. Or not. Yes, ma'am?
So do we have to have the investment in affiliate entry?
Oh, yeah. Your investment in the affiliate went up because you gained it. Absolutely you do. But you don't do anything with the change in market value. That's the trick. What if they have a loss? You'd still have the entry, but your investment was going to have a loss, credit the investment. Okay, got it? Okay, so shit, yeah, you got to have it. All right, all we have left is dividends, you guys. In every case, do we get the dividend? Yeah. How much dividend would you get down here? It's going to be the same on all of them. It'll be the same on all three on this one, too. Except it's not no entry, it's an entry to record it. How much dividend are you going to get? How much dividends per share are there? It's 400,000, there's 600,000 shares. What's that? $400,000 divided by 600,000 shares. 66 cents. 400,000 dividends. And there is 600,000 shares. 66.666 forever.
Yeah.
Leave that in your calculator, right? Yeah. That's what it is. Times 6,000 shares is what you get if you only own 6,000, right? If you own 210, it's times 210. If you own 450, it's times 450, of course, right, guys? So how much cash do you get? If it was 6,000, $4,000, right? That's what that is, isn't it? 2/3 of 6,000, right? And credit what? Dividend revenue. I am taking what the market gives me, and what the market gave me was the increase in market value plus the dividend. Got it? That would be the same on all of them, okay? On investment in trading securities available for sale, short-term or available for sale, long-term. Same, okay? Easy, isn't it? Okay? What would we do, though, if I have an investment in an affiliate? Do I still get cash? Sure, but how much cash would I get? 210,000 shares times 67 cents. How much is that? It's $140,000, right? It's 2/3. Right? Those were thousands here, right, guys? 140,000. And credit what for 140,000? Yeah, investment in affiliate. Here's what happened. You made 350,000 this year, right? And you gave yourself 140 of them. Right? Just like retained earnings for a company, earning net income and then paying it. Right? Same thing. All right? What do you do if it's controlled? You still have to record cash. How much would it be, by the way? 450 times 67 cents, 300,000. They get 300,000 of that, right? Obviously, they get 3/4 of the 400. It's 300,000. And you can do it either way. I won't give you this anyway on a test or quiz. I'll separate the consolidated one out. You just have to do an elimination increase. You won't have to worry about this one. But you could be either credit dividend revenue and eliminate the dividend revenue, or it could be credit investment in subsidiary and eliminate that. Okay, doesn't make any difference. Okay, good. So let's do consolidation. And we'll use this over here, or basically this over here. Okay, I'll make up another one. But let's take a look at this. What do we do if we have an investment in a subsidiary? Okay, Now, this is not in the book. What they showed you in the book is merger, didn't it? Right? You read the chapter? What happens in a merger? One company bought another company, and one ceases to exist completely. What they do? They debited all their assets, right? The market value of their assets. And then what? Credited the cash they gave them, credited stock if they gave them stock, credited liabilities if they assumed liabilities, and that's it, huh? There's no gain or loss, of course, on buying another company. Buying assets, you don't have gains and losses. So that's pretty straightforward. That was pretty easy. This isn't bad either. You're going to see a lot of consolidated financial statements. Any major company owns other companies. Big companies own other companies. What do we mean by that? They own at least 50% of their stock. So the other company is a subsidiary, and the company that owns the other company is the parent. Really big companies might own a couple hundred other companies. Got the idea? When they do financial statements, you put them all together. When they do the tax returns, you put them all together too. It's all one entity. Because if I own 50% of the other company, they don't exist anymore. I still exist. They don't, right? When we vote, I win. I run it, right? Okay? And the people who own the rest of it, let's say I own 75%, the people who own the other 25% are called the minority shareholders, minority interests. They really don't have any control whatsoever. Why would they want to keep that investment? Because the company's making money and they get 25% of the dividends, right? Right? 25% of the profit really belongs to them, right? So they might still keep it. You don't have, I have all sorts of investments, all sorts of companies I have investments in, right? I don't control any of them. I don't want to control any of them. I don't want to have to run some company. This is what I do, right? Okay? So there are people who are running those companies making me richer. Sometimes making me poorer, but usually making me richer, like that. Okay? Not bad. Slowly. All right. So let's say we have an investment. Let's say we've got a company, XYZ company. And we have ABC company. ABC company is going to be the parent, okay? They're going to own the other one. This one is going to be the subsidiary, okay? And let's say that XYZ company has common stock, oh, I don't know, let's make it 1 million shares. And let's say they have a par or a stated value of $1 per share, okay? Well, first, what would be in their common stock account? They have 1 million shares, oh, I should have said, issued and outstanding. Every time they issue a share, they credit common stock for $1, and there's 1 million of them. What is it? $1 million? Yeah, I think common stock's $1 million. Know you guys? What if it was a $2 par? It'd be $2 million. What if it was 10-cent par? It'd be $100,000. Got the idea? That's it. Okay. And let's say they have additional paid-in capital on their books. This is the subsidiary's books, and it is $4 million. What does that mean? What was the stock sold for per share? We did this in the equity chapter, didn't we? Just did it. What was the stock sold for? $5 million in total, right? 4 plus 1. $5 million in total. Everybody agree to that? How many shares are there? 1 million? What's the average issue price of the stock? $5, right, guys? That's all it is. And then let's say they've been in business a while, and they have retained earnings of $15 million. Would you like that if you had invested $5 million and it is now worth $20 million? Or I'm sorry, they have retained earnings of $15 million. So my total book value of my equity, not what it's worth, but the total book value of the equity is what? My total equity would be what? One plus 4 is 5 on paid-in capital, plus 15 retained earnings, right, guys? 20 million. Okay. Got it? That's true. Okay, and let's say I buy 75%. So 75% of stock. And let's say at the time that I buy the stock, the market value is, what do I got here? $25 per share. Okay? And I buy 75%. my investment that I'd make. Let's do the journal entry to buy the stock. Let's say I buy the stock. What would be my journal entry? Now this is going to be on the parents' books. This is the subsidiaries' books. All this stuff's on, right? This is on the parents' books, right? Two separate companies. This is going to be a worksheet elimination entry we're going to come up with. You don't put it on either company's set of books. Why not? They're separate companies. They keep running independently and do their own financials, right? Their own financial statements. Okay, so what do we do here? Debit what and credit what when you buy a subsidiary? Awful quiet. Debit investment in subsidiary, XYZ, right guys? And credit cash. And suppose that. How many shares are we getting? There's 1 million outstanding. We're buying 75% of it, 750,000. Everybody agree with that? What are we paying per share? The market value is 25 bucks. What's 25 times 750,000? How much? 18,750. Cool. Everybody knows this, right? Okay. Now, I'm combining these two companies. And remember, I might have 100 companies I'm combining. So I do a big spreadsheet, Excel spreadsheet, or any spreadsheet. What would I do? I'd have 2 columns for the parent, debits and credits, all their accounts, in their general ledger, assets, liabilities, equity, right, revenues, expenses. And then I'd have 2 columns for each one of the subsidiaries. So there's 100 subsidiaries, I guess I'd have 202 columns so far. Then I'd have 2 more columns for an elimination entry, where I eliminate all the intercompany stuff. Because can I have an investment in myself when I put the companies together as one company? Of course not. You can't have an investment in yourself, so you get rid of it. And the equity of the subsidiary we get rid of too, because they don't really exist. And we'll record a minority interest, right? And we might also revalue some assets, okay? All right. So I want to eliminate this investment on the parents' books, and I want to eliminate all these accounts in the subsidiaries' books. Let's say I also have land that has a book value of, $3 million on our books. And let's say the market value for that land is $3,500,000, okay? So what I'm going to want to do is I'm going to want to increase that by 500,000 when I put the companies together. And let's say there are no other assets where the book value and the market value are different. This is a ridiculous situation. In a real consolidation, what would happen? One company buys another company, they have a whole lot of assets they're going to revalue. You only revalue the assets of the subsidiary, okay? Because it was purchased, so we know what the value of those are. We don't revalue all the parent's assets. The only time you know what those were worth would be if you sold the company, okay? And how much of this company we buy? 75%. How much does somebody else own? 25%. So let's try this, okay? So this is on the parents' books, this is on the subsidiaries' books. Let's do the elimination entry. This is on nobody's books. It's just on that worksheet I just described, okay? Just on that spreadsheet. Okay, what do I want to eliminate? I can't have an investment in myself. So when I add up all the assets of all the companies, right, in this case 2 companies, when I add up all the liabilities, the equity, got the idea, the revenues, the expenses, what's the deal? I don't want this account, do I? So how would you get rid of it? It's got a debit balance. How would you get rid of it? Credit. This is going to be easy. Investment in subsidiary. How much? The 18,750's gone. Now, if you change that over time because you're using the equity method, you'd eliminate whatever's there. I won't do that to you. In accounting 414, if you become an accounting major or a double major, and accounting's one of them, we'll do it there. Okay? Almost the entire class is on consolidations, you guys. This is a huge area. Because we have to add together all the assets, liabilities, equity, revenues, and expenses, and eliminate any intercompany stuff. What if the parent's doing business with subsidiaries, which is almost always the case? You got to eliminate all the revenues and expenses for doing business together, all the profit for doing business together. Any assets you bought and sold from each other at a gain or a loss, you got to eliminate all the gains and losses and revalue the assets, because you're doing business with yourself, right? And you can't do business with yourself. Okay, so it's a really big job. Anyway, so credit investment in subsidiary, and that one's gone, isn't it? What else do we want to get rid of? Let's get rid of all these equity accounts. So how would you get rid of $1 million of common stock? How about debit it? This is too easy. You will not miss these, will you? How would you get rid of the additional paid-in capital? Debit it. And all of a sudden, that subsidiary's equity is going away. What's the other piece of equity we have for them? Retained earnings, right, guys? Get rid of the retained earnings. Could there be other equity accounts? Yes. I won't give you any more, but you guys know there could be, right? You'd have to eliminate all the equity of the subsidiary. Every equity account. I'll only give you those three, probably. Does that journal entry balance? Nope. What else do I know I want to do? I want to revalue land by 500,000 up, don't I? Okay, and I'll just write it into the problem. I'll have to give you that, right? Okay, so what will we do? We'll debit land, won't we? Make myself enough room. Okay, debit land for 500,000. Sound good? Does that journal entry balance? No, it doesn't. What are we missing? Okay, I bought 75% of this $20 million in equity. Does everybody agree with that? I bought 75% of that. What did I buy? What's my equity share? What's 20 million times 75%? $15 million? Everybody agree with that? That's my share. What did I not buy? The other 25%? Common sense. Who owns that? This is the parent. Who owns the other part? The minority shareholders. And that's what? 5 million? You guys agree with that? Has to add up to 20, of course. Okay? So this is the minority interest. Oh, the minority interest is a portion I don't own, huh? I don't owe them that money. It's not a liability. It's stock, right? I don't have to pay them. It's not really equity in the combined company because they don't have a vote, right? So what we're going to do is we're going to show all the liabilities of the combined companies, the consolidated companies, and we're going to show all the equity of the combined companies, which is just going to be the parent, right? And in between, we'll have a line that says minority interest. That represents the portion of the stock that is owned by what? Combined company stock that's owned by who? Minority shareholders. It can be a big number, okay? So now you'll know what that is. That's what I want out of this, okay? I want you to work on this hard enough so that you'll know what it is in real life when you look at real financial statements, okay? That's what we're going for here. So that's like a liability. So what do we need to do? I think record minority interest. What do you think? Right? And it's a credit because it's sort of equity, right? Okay? How much is that? 5 million. Does that journal entry balance? No. Tell me how much we need. What do we need? Add up the debits, subtract the credits, and what's the difference? I need a debit, don't I? 23,750,000 less all those. How much do I need? I don't know how much that is. I guess it's 3,750,000. 3 million. Oh, 250. Yeah, okay. It's 3,250,000. I left out the land. Guess what that's going to be? I paid more than the book value of the assets. Even more than the market value of the assets. Look at this. What's my investment? What I invest? 18,750,000. Everybody agree with that? What's my 75% equity? 15 million. Everybody agree? What's the excess I paid? $3,750,000. Would everybody agree that I gave them $3,750,000 more than the book value of the equity when I bought the stock? What did I pay for it? increase in land, and in real life, there wouldn't just be one asset, it would be adjusted, a whole bunch of them would. You got the idea, equipment, building, inventory, all kinds of stuff, receivables, they could be increased and decreased, liabilities would be changed to market value, got the idea? So it's a big deal, right? But for our purposes, it gets the point across, right? So we got 500,000. So what did I pay in excess of market value here? $3,250,000. What do we call that? When you pay more than the market value of what you bought when you buy another company. This is where that intangible asset shows up. Remember we did the intangible assets? What do we call this one? Anybody know? I paid more than the fair market value of the company I bought, right, of their assets less their liabilities. What am I buying? Future earnings I think they're going to have, right? What do we call future earnings that we're going to get? If we started a business together, the three of us started a business together, we put a bunch of assets in, if we ran it for a year, do you think it'd be worth more than the assets we put in? Because we're all brilliant people, right? And we all work really hard. What would happen? Our customers would love us. Is that valuable? Future sales, yes. Our employees would love us. Is that valuable? And they're trained. We train them, right? Valuable, huh? Government relationships. The government loves us. Nonprofit organizations love us. Our vendors love us. Got the idea? Right? Are we worth more than the assets that we invested? Of course we are. What do we call that? What have we built? People love us. Goodwill. The only time you could measure goodwill, though, because what we could do is if we wanted to, we could just debit goodwill $100 million credit gain from increasing goodwill. Do we go to the bank and borrow money with that? They think we were nuts, right? Now, you can't measure it, right? And after 1 year, I doubt we'd have that, right? Okay, but you can't measure it. When is the only time you can measure it? When the company gets sold. What just happened here? One company bought the other company. At that point, you know how much goodwill is. Ah, that's where it comes from. So what do you want to call this stuff? Goodwill, it's an asset. Goodwill, it's an intangible asset named goodwill. Pretty clever, huh? Now, when you see goodwill on a company's balance sheet, what do you need to ask yourself? Does it really exist? What do we mean? Their reputation, right? Their products, their employees, their customer relationships, their vendor relationships, their government relationships, their employees, whether they like working there or not. Have you got, is anybody in here got a favorite restaurant? Most people have one, right? Why is it your favorite restaurant? Does it have nicer tables and nicer chairs and nicer silverware? And well, maybe, but that's not really what it is it? What do they have? Better food, better service, better ambiance. You get treated better there. The whole experience is better. Oh, well, wait a minute. They have the same tables and the same chairs and the same silverware and, you know, all that stuff. And they have people wandering around with food. Yeah, they've got everything's the same except what? They do a really, really good job. And that's why you like them, right? They have goodwill with you, don't they? They do. Anybody have a restaurant they absolutely hate and they'll never go back again and tell all their friends not to go there? We all do, right? Okay? What do they have? I guess ill will, but we don't put that on the books, right? But if they get sold for less than their book value. They bought a bunch of assets and turned them into less, right? By running their business. Got the idea? Well, we wouldn't call that negative goodwill. Let's just write all the assets down. Okay, anyway, everybody got the idea of this? Could you do this for me? The answer right now is probably no. What's it going to be like next time I see you? Yes. Okay, here's the deal. Next time, and the next few times, we are going to do cash flows, right? There are two problems on cash flow. Listen to this part. There are two problems on cash flow. That will look at it right after I said that. Okay, there are two problems on cash flow. They're out on Moodle. You probably haven't seen them yet. Be sure and get those. Try and work both of them. Read the chapter. It's good. They do a good job. In the chapter, they don't show you a full problem all the way through. So I pulled these two problems out of a different textbook. It's actually the textbook that you're going to use in managerial accounting next semester, in Accounting 102, right? But anyway, There's a cash flow chapter in there too, but we won't cover it there. We're doing it here. It's in both books. Okay, anyway, use those two problems. Work them, right? And try and do them before I see you on Monday. Well, I'm going to see you Monday. That's right. Before I see you on Monday, try to do both. We'll work one of them, and then in the review session, we'll work the other one. But try and do them. It'll really pay off. Really pay off. Okay? All right? So see you guys. Keep working. That is close. That, at least you hit the basket there. Better than I would have. I'm lucky if I hit the basket. See you guys.
Okay.
I think like the previous semesters that I had 12, so I think I'll be filling that summer.
There you go. Yeah. That's good for ahead of the game. You could only do 9 this summer if you want.
Do not, oh, no.
Did it 12? You want to keep going. I don't care.